Accounting for investment is number 13. What are the things we are going to cover under this is, why do we have this accounting standard? In what are the scenarios this accounting standard not applicable? Some terms are also defined. These are the three aspects you have to cover first. And investments are also be classifiable and defined here. How do we classify that? So that investments are usually classifiable as current investment, long-term investment, investment properties. As per the classification, how can we value the worth of investment, cost of investment, computation of cost of investment? Sometimes stated, if you are selling the investment, what to do? Disposal of investment. You purchase the asset stating that it is going to be long-term investment, keeping it for more than 12 months. But immediately after 3 months, we plan to shift this to current investment because we are in need of fund. Then if you are reclassifying this, then what can we do related to the accounting? And finally, disclosure requirements. So these are the components that are studied under AS number 30. Purpose: accounting for investment in the financial statement of enterprises and establishing related disclosures. That's what about the purpose. One is all about accounting, another one is all about disclosure of this. For what this will not be applicable? In case of payment of interest, dividend, rental from investment, means revenue from. See, if you buy the debenture and if you buy the share capital, or you have the surplus fund, so spare amount you have, you purchase a land and building, keeping idea that it will be inflated sometimes later, so we'll make a cash in it or profit in that. Singar Academy purchases a land for constructing Singar Academy is a property, plant, equipment for the assets. AS number 10 will be applicable. If I have surplus fund and I got the message that the plot nearby costing currently 10 lakhs may go up to 20 lakhs. So with an idea of investing and later I can sell for 20, then it's called property investment. That is called property investment. So these are the three classifications we have: debenture, share, and property investment. Property investment. In case of debenture, you will get the interest. In case of shares, you will get the dividend. In case of property investment, temporarily rather than keeping idle, we can let it out for rental purpose. But this AS 13 is applicable only for this. For this, it will not be applicable because this will be studied under AS number 9, revenue recognition, already we studied. So for this we deal on AS number 13. For this we deal in AS number 9. Clear? And in case of operating and financially studied in the AS number 19, this will not be applicable. And in case of investment for the retirement benefits payment as per AS number 15 and life insurance enterprises, this will not be applicable. Mutual fund and venture capital funds, banks and public financial institutions formed under an act also be applicable, not applicable. So in these cases, this is not applicable. Let's start with the definitions. So investments are the assets held by the enterprises for earning income. Already told maybe dividend, interest, rental income, or even capital appreciation, other benefits. Okay. Assets held as a stock in trade. If you are being the real estate businessman, buying the plots for sale as a regular business operation, then the plot will not be considered as an asset. If we, not being the real estate businessman, purchasing the plot maybe held for a long-term investment, that will be coming under investment. For them, it's a stock in trade. Now you have to understand the term fair value. Fair value is nothing but the market value or NRV. Okay, between these two, more clear evidence based item will be taken. Okay, so fair value is nothing but the transaction value fixed for selling and buying between knowledgeable, willing buyer and seller. So buyer and seller are willing to buy and sell. Not only that, they are aware about the price of the commodity. If A, seller is not aware about the price of the asset and buyer knows what's the real worth, so he may manipulate him. So there is a chances of manipulation, that is not fair value. So A also, the seller also knows what's the right price and buyer also knows what's the right price. Only then it is called fair value. Now let's see. Market value. Market value is nothing but open market price, the price available in the market for sale. From there, any expenses on sale will be subtracted. So sale price minus expenses on sale will be market value, otherwise named as NRV. Carrying amount is nothing but the amount you paid for purchasing this or fair market value. Between these two, whichever is lower will be taken, like similar to inventory, cost or NRV, whichever is lower. Where you have 3 or 4 investments, then you have to calculate the cost or fair value individually for every investment and take the lower of these two. And forms of investment, how can you do the investment? You can invest in securities like equity shares and debenture having no physical substance, or investment in property. Okay. In case if you are investing in property, this will be accounted as per cost model in AS number 10. AS number 10. So you can invest in debentures, preference share capital, and equity share capital, and property also. These two are coming under this case, and this will be dealt as per this one. Okay, AS number 10. Investment in land and building, and not for your personal business purpose, right? If the property purchased not for your personal business purpose and held for capital appreciation or revenue generation in addition to the regular business, then that will be called as property investment. Hope you'll be now able to understand what are the forms of investment we have. Debentures and shares. These are called securities having no physical substance, and this will have the physical substance. And cost of the share being 50, investment property cost being 5,50,000. Okay. Now what happens here? This is what about the exchange link. Cost of adjustment for investment property and related shares. Shares in cooperative society or company are directly related to the right to hold an investment property. Member, cooperative society. To become member in that, you have to pay what? Membership fees or entrance fees, whatever it may be, you pay. 50,000 rupees you paid. Then the property is allotted to you for a additional consideration. Okay, residential house property, whatever it may be. For that, you will be releasing around 5 lakhs rupees, consideration being 5 lakhs. So you paid 5 lakhs rupees for purchasing the residential house property. To purchase from the cooperative society, you need to be member. If non-members are coming for purchasing, then cooperative society will not sell. So if you want to purchase the property from the cooperative society, you need to be the member. So the amount payable for the residential house property being 5 lakhs, but to become the member, you paid 50,000, means the property's value being 5 lakhs 50. Is that clear? Okay. Now, this ensures an accurate reflection of the total investment linked to the property. That's the logic. Now, let's see the classification of investment. So, investments are classifiable, okay, like what? Current investment and long-term investment. Investments are classifiable into current investment and long investment. Current investments means the period of holding is less than or equal to 12 months. Thereafter, you will plan to sell and encash it. Then it is called current investment. Or if the period of holding is more than 12 months, then it is called long-term investment. First part. Second, held for. How can you decide whether it is a current or long-term? Based on the period of holding. How can you value, sir? How can you value? In case of current investment, cost or fair market value, whichever is lower, will be taken. In case of long-term, you have to always record at its own cost. Less loss other than temporary decline. Okay, other than temporary decline. See, I have investment B, investment A and B, and the cost for A being 100, but fair market value being 80. Another asset being 120, fair market value being 150. Now, between these two, whichever is lower 8, between these two, whichever is lower 120, the investment worth being 200 in case of current investment. If you take the total value 220 and this will be 230, can you take between these two, whichever is higher? No. We have to calculate all the assets individually. The cost and fair market value for each and every asset should be taken individually. Then you can find out the total value of all the investments put together in case of current investment. Suppose A, B, these two are non-current investment. The cost being 100 and this being 120 and fair market value being 80 and 150. Now in case of non-current investment, we never bother about this one. Okay, and the market value may be 80 or 150, we never bother, but provided the value being only 90. Why? 10 rupees lost, due to some permanent decline. Probably you may invest in company A. In company A, whatever the investment you do, so you think it's worth rupees 100. Based on that, you invested. And the company is also operating genuinely. You are able to value the assets worth at 100 only. Sometimes, there may be some riot or natural calamity or government announcement leads to a fluctuation in the market value. As there's an impact in the market value, what happens then? There's an impact in the market value. Clear? As there's an impact in the market value, due to the market trend, the 100 becomes 70. Do you want to undervalue this? No need to undervalue that. It's a temporary only. Provided, if that business met with a fire accident, a major operational unit got distracted. Because of that, definitely there will be loss in revenue in the subsequent period. Due to that, around 10 rupees is going to be lost in the fair market value of the asset. Then what we can do? Then you can undervalue this, you can show this being 90. The difference between these two, 10 being assumed to be the permanent decline. If you consider that value being the permanent, not a temporary merely because of the change in the market value, then that permanent decline value should be subtracted from the value in case of long term. So cost less loss. Which loss? Other than temporary decline means loss. What type? Permanent decline loss will be subtracted. But in this case, it is not so. But anyhow, you should calculate each and every asset separately, not in aggregate. If I have 5 investments, you have to calculate for each and every investment separately, not in aggregate. Okay? Individually. In case of current investment, individually. This is the prudent method. Or it seems to be very tough to follow this method and complicated. Then you can depend on category wise. Category wise means equity share capital, debentures and bond, even T-bond. I want to calculate the fair value, cost and fair market value for this separately, I am grouping all sort of similar nature of assets, and the cost and fair market value of that category will be taken as value of the current assets, also be accepted, but provided you have to understand, individually will be better one. Rarely you can follow the category wise also. Reclassification. What happens if you are reclassifying that into current to non-current and non-current to current? Okay. In case of current, remember, you value at cost or NRV. No. If you want to convert this current to non-current, what value you should always show? Cost. Then what happens here? If you are converting current to long term, cost or fair market value on the date of conversion will be taken. Once it is taken, that is final. As the date of conversion, cost or fair market value of the asset will be taken, that is final. But in case of long-term investment is converted into current, then cost or the value carried in the book, because in the book it will be shown at always cost. Okay, if it is being the permanent decline, we will reduce it. So always it is appearing at the book value, which is equal to the cost except the permanent decline. So you have to take the cost. Due to the permanent decline, if there is a reduction in the value, that one. Between these two, whichever is lower will be the current investments value. Or now see in your balance sheet, non-current investment 100, there's a permanent decline 10 rupees, so now you showed at 90. Sometimes later you want to convert that to current investment. In this case, cost being 100 and carrying amount being 90, between these two, whichever is lower will be taken. Not only that, in this year, this will be considered as cost and fair market value on the date, probably 70, as now hereafter it's current means between these two, whichever is lower will be taken. The date of conversion, on the date this value will be taken, and always cross-verify with the market to take whichever is lower of cost, the value identified with the market value. This is what about the reclassification case. And fifth point you have to understand here being, and you may sell your entire investment in single shot. Then in this case, any profit or loss will be transferred to the P&L account. You have A, B, C, D. 4 shares or 5 shares you have. You thought to sell all the 5 shares. This share purchased at 105, this share purchased at 110, this is 95, this is 90, this is 98. All the shares put together sold for 600. Then the entire difference between this one and that one will be either profit and loss transferred to the P&L account naturally, right? But what happens, only 2 shares are going to be sold, not all the shares. If only 2 shares are taken, the sale price of the 2 share being 250. Okay, then what about the cost of sale of shares? 2 shares sold, no. Then you can depend on the inventory valuation like FIFO method, LIFO method and average method. So if you follow the FIFO method, the first item sold for purchased for 105, second one purchased for 110, so the value being 220, 15. Then the profit being 35. That's how you can recognize if you are following the FIFO method. As per cost formula in AS number 2, you can follow FIFO method, LIFO method or average cost method you can follow. Clear? Now, in case of loss, debit to P&L account. In case of gain, credit to profit and loss account to the extent of cost. Okay, to the extent of cost in case of gain. In this case. Okay, in the case of gain, to the extent of cost only credited. Balance will be ignored. Right. See examples other than temporary decline. Value reduction due to cash operating losses. This year the company lost some money, can be adjusted other than temporary loss because their business is lost. Means permanent decline. Usually the business gives you 100 rupees sales revenue. In this year they make only 70 rupees sales revenue. There's some impact due to the operations, not due to the market fluctuation with respect to the market price of the share. New regulation which has negative impact. Suddenly government announces hereafter you will not be allowed to produce the plastics. Or suddenly what happens, the last time government announced waiver of the tax rate for the cars. Immediately car sale got boomed. Almost all the cars price reduced by 10%. Immediately car sale boomed. You understand? And if the rate of interest tax is increased, then automatically car sales will be down. So if you are being the investor in the car industry, you can decide whether you are going to adjust the loss or gain with the cost. Okay, this is also permanent decline. Significant reduction of quoted price of the investment. That company's quoted price in the market is drastically reduced. 100 rupees is the purchase price. Suddenly what happens, the price sold at 20 rupees in the market. Only this share, not for the entire share. All the shares in the market are almost same price. Only this one lost its entire value, 100 to 20. Then this will also be called as permanent decline. These 3 are called permanent decline. Next. So this one you might have studied in your taxation. How can you determine the cost for the shares, right? In case if you are issuing the share or purchasing the share by paying the cash, price you paid, brokerage you paid, fees or other charges applicable for that will be added. That's what about the cost. But if you are giving in exchange of shares or securities, you purchase one share, for that another share is given. Then fair value of the share securities issued will be the cost. So A and B, you have given debenture. Okay, you have given debenture and get equity share capital instead of the convertible debenture. After the conversion means after the tenure ends and he gives the debenture and gets the equity share capital. Originally he purchases the debenture for ₹100. Now he got 2 shares of ₹10 each. 2 shares of ₹10 each. So 10 rupees each. But now for the 2 share, the value being 100 means per share is 50. 10 rupees is the face value, balance 40 will be the securities premium. The price for the equity share capital in this case is the price you paid actually for the debenture. The price you paid for the debenture being 100. For that 100 you will be getting 2 shares means 50 rupees each share. But the shares face value being 10 means you show that at 50 means that additional value will be your securities premium. Okay. In exchange of other assets, okay, A and B, you give your plant and machinery or you purchase the plant and machinery. For that you are offering them what? Equity share capital. You purchase the plant and machinery, you are offering the equity share capital. In that case, fair value of the asset given up, which asset is given up, plant and machinery or whatever it may be, or fair value of the investments acquired, whichever is more clearly evident will be taken. Okay. In case of interest, dividend and rental, out of pre-acquisition profit and post-acquisition profit, the fourth point is very, very important. Fourth point, okay? Let's see in the case of fourth point. Interest, dividend and rental. Interest, dividend, rental. Okay. Out of pre-acquisition profit and post-acquisition profit, in case of pre-acquisition profit, this is nothing but a return of investment. In case of post-acquisition profit, this is credited to the P&L account. You might have studied all those things in which chapter? You have studied this, right? Where? Holding company, subsidiary company, consolidated financial statement. The same logic is applicable. This chapter is the base for understanding the consolidated financial statement. How do you calculate the investments value? Okay. So you segregate the profit into capital and revenue. Revenue profit will be credited to the P&L account. Any amount out of the capital profit is going to be adjusted in the investment. Okay, if you are getting the dividend. So the dividend you receive being 1,000 rupees, out of that 1,000 rupees, 300 being pre-acquisition profit, another 700 rupees being post-acquisition profit. Then how can you pass the entry? You get the money bank account debit, 1,000 rupees, out of that 700 post-acquisition means it's a gain credited to the P&L account, and 300 rupees is a returning of your investment, will be now considered as sale of investment only, bank account debit to investment 300. You have to understand this point. This is very, very important. So in case of pre-acquisition profit, it is deducted from the cost of investment. In case of post-acquisition profit, it should be credited to the P&L account. Clear? Now let's move on to the fifth one. What happens in case of right shares? You might have studied that also in taxation. So, XYZ company, okay, XYZ company, A being the current shareholder. Now, he can get the right share from him and he can make the consideration for that being 100. Or A can transfers his right. He has to pay 100 and he has to pay right also. XYZ company offers him the right to purchase a share at rupees 100 as he is being the existing shareholder. So to purchase a share, he has to give his right and 100 rupees to get the share. Rather than he purchases by paying 100 rupees and right, he simply transfers the right to X. Right to X. For that, X makes a payment of rupees 20. Now X hands over the purchased right plus 100 rupees to purchase the share. Now for A, if he purchases directly, the cost for him being 100. If it is purchased by X, first he purchases the right for 20. With that right, he pays 100 rupees to purchase. The right's value also be 10. So now for X, the cost being 110. For A, the amount he transfers the right, that will be similar to dividend. Whether the right price being the pre or cum right or X right. There you might have studied the cum dividend and X dividend. Pre-acquisition or post-acquisition. Similarly, a cum right and X right. If it is being the cumulative right, it will be subtracted from where? Means out of pre or post like. I name this being cum right and this may be X right. In case of cum right, this value is already included, so you have to subtract this 20 from here. In case of X right, this 20 rupees can be transferred to the P&L account. So, right shared subscribed, first scenario, actual price payment paid 100. And right sold, whether the pre-acquisition nature or post-acquisition nature. In case of post-acquisition nature, P&L account credited. In case of pre-acquisition right sold, then it is deductible from the cost of investment. And purchased right and share. I purchased the right by paying 10 rupees and for share I paid another 100. So in this case, my consideration being 110. Is that okay? I can execute the right or I can sell the right. Third party can purchase the right and pay the money to purchase a share. Okay, while selling the right, whether it is a pre-acquisition or post-acquisition model, you just think, or in case of post, it can be transferable to the P&L account. In case of pre, it can be adjustable in the investment. Now, pre-acquisition period. What is called pre-acquisition period? Okay, see, first April 2025 to 31st March 2026. You purchase a share on 1/1/2026. For the 100 rupees, you got around 10% interest. 10% interest. Is that okay? 10% interest. 10% interest being 10. I can make it 12%, 12 rupees. In this, up to the date of purchase, 9 months, for the 9 months, the interest being 9 rupees, and for the post period, it is 3 rupees. This will be called as pre-acquisition dividend. This will be called as post-acquisition dividend. Clear? Interest or rental accruing before the acquisition. This is the acquisition date. Before that, if any, that 9 rupees will be this one. And in case of interest and rental. In case of dividend, before the dividend declared. These two are called pre-acquisition. Now, investment accounts. How are you going to account this? That is a very, very important chapter for you. Now we are going to record that investment in your books. How will you record? Investment could be in where? Equity shares, preference shares, debentures, bond, government securities, investment properties and all. In case of investing in debentures and bond, you will be guaranteed getting interest without any deviation. If you are investing in the preference share also, you will be getting a constant return. Sometimes there will be chances of missing. In case of equity, you are not sure with the returns. You may get, sometimes you don't get, sometimes exorbitant amount also you get. So these investments can be categorized into fixed income bearing securities and variable income bearing securities. Government securities, debentures and bonds are called as fixed income interest bearing securities. Variable income bearing securities are nothing but equity shares. Nothing but equity shares. Is that clear? Now, let's solve the illustration one after one. Some small discussion based illustration, then disclosure. With that topic is over, we have to then go for comprehensive illustrations to be solved. This illustration very easily you can guess how. You just open the investment account. It's an asset account. Like similar to asset account, you have to open this asset account and treat the pre and post acquisition dividends and interest as per the logic we learned in consolidated balance sheet, consolidated financial reports. Is that okay? In the old material, earlier batch material, the illustrations are not in coherency order, but here I just arranged in so coherency order, and then the calculation part also I introduce a new format, that's all. Rest of the things are already available in the material, but working is different and arrangement is also different, right? Let's see. A company has invested substantial amount in the shares of another company under same management. The market price of the shares of the aforesaid company is about half of that at which these shares were acquired by the company. They acquired for 100, today the market price is 50. The management is not prepared to provide for fall in the value of the shares on the ground that the loss is only notional till the time the shares are actually sold. So the demands are, we no need to undervalue this, we can continue to show in the books at 100 only. What happens in case of non-current investment? Non-current investment will be always shown at cost less permanent loss. Permanent loss, okay. So this management speaks that this is not the permanent loss, only temporary loss, so I will finalize only at the last. Is that statement correct or not? Definitely not. So permanent loss means you have to subtract. In case of notional loss, you need to subtract. So here the management is not prepared to provide for the fall in the value of shares on the ground that the loss is only notional. Till the time of shares are actually sold, not required. No, see this decrease is exorbitantly high. 50% down. In case of exorbitantly high, already we have seen, no? Here somewhere, exorbitantly high. The third point, significant reduction in quoted price. Almost 50% reduction. So significant reduction happened. So definitely you have to undervalue, show this being at 50. The management discretion is not acceptable. Next. An unquoted long-term investment, unquoted, is carried in the books at a cost of rupees 2 lakhs. The published accounts of unlisted company received in May 2021 showed that the company was incurring cash loss, which declaring the market share in the long-term investment may not fetch more than 20. How will you deal? So as the cash loss, this is being the permanent decline, definitely that value will be now decreased. So you have to show the books, the means value of the asset being only 20. It will not fetch more than 20 means its today's value is only 20. You lost almost 1,80,000 rupees. You have to consider this being the permanent loss. You have to think whether it's a permanent loss or temporary loss, and it is again consider whether it's being the current or non-current. Okay. In case of property investment, it will be as per AS number 10. That will not come here. Okay. X Limited on 1121 had made an investment 600 lakhs in the equity shares, of which 50% is made in the long-term category and the rest temporary investment. So 600, then non-current investment and current investment. 300 non-current investment, 300 current investment. Okay. The realizable value of all such investments become 200 lakhs as Y Limited lost as a case of copyright. From the given market condition, it is apparent that the reduction in the value is not temporary in nature. How will you recognize the reduction? So today the value being only 100 means this is also 100, this is also 100. 200 means 50% 100, another 50% 100. Now, in case of current investment, you have to show at 100 only, whichever is lower. Cost minus cost or NRV, whichever is lower will be taken. In case of non-current asset, today's value is 100 means this 200 loss is considered as permanent decline. So permanent decline should be subtracted. So hereafter in non-current investment show 100, in current investment show 100. But the calculation method is different. In the first case 300 minus permanent decline 200 rupees. In the second case 300 but NRV being 100, between these two whichever is lower will be taken. Hope you'll be now able to understand, right? Next case. ABC Limited wants to reclassify its investment in accordance with AS number 13. Decide on the amount of transfer based on the following information. The portion of current investment purchased for 20 lakhs to be reclassified as long-term investment. Okay, non-current investment. So 15, 6.5 as reclassification is carried over, whichever is lower on the date of reclassification is taken. So then the value being 6.5. And from the book value, if you revalue at 6.5 means difference between these two, 8.5 is the loss debited to the P. 6 lakh should be permanent loss. Now if you are reclassifying this as a current, what could be the value here? Now let's move on to the next one. Disclosure. Ends with the disclosure now. Disclosure for investment. Accounting policies you adapted for determining carrying amount. How do you classify? How much you transfer to the P&L account in this year? What are they? Related to the interest, dividend and rental. If there is any TDS advance tax that should also be posted. On disposal, how can you treat? Current, non-current transfer and how can you handle that? Restriction. The investment is what you have, you know, you cannot transfer as you wish. There may be a commitment to hold at least 5 years. That is called restriction. You have to intimate this. You don't have the rights to sell as you wish. Ownership rights. And if you want to suddenly sell, will you be able to sell at the market rate, which is called realizability of investment? There is also doubt, it will be really tough. Or remittances of income and profits of disposal. So if you are getting any revenue, will it be safer to get without any restriction? And if you sell the asset, the value of sale will also be eligible for getting it right. So these are the things you have to understand that. And fifth being aggregate value. Total for quoted and unquoted investment. Total for quoted and unquoted investment separate. How many investments are quoted, how many investments are non-quoted, and its market value. Everything will be stated properly below the balance sheet. Statutory disclosure, if any, in addition to the illustrative disclosure, anything applicable that should also be disclosed. Is that clear? Now, Messrs. Innovative Garments Manufacturing Company Limited invested in the shares of another company on 1st October 2021 at a cost of rupees 250. So cost being 250. It also purchased gold 4 lakhs rupees, silver rupees 2 lakhs. On 1st March 2019, the market value on 31st March 22 of the above investments are given here. How above investments will be shown in the books of accounts of Messrs. Innovative Garments Manufacturing Company as per the provisions of AS number 12. So gold and silver are investment properties. This will be shares, okay, that too variable return securities, right? Here, if it is being the current one, you have to calculate whichever is lower of these two. How much? 2,25,000. But in this case, you usually follow the AS number 10 like, usually we show at cost. We show at cost, not NRV. This is NRV, this is cost. So 4 lakhs and 2 lakhs. Okay, this is 2.25 lakhs. In total, 8.25 lakhs. Illustrations related to this topic. I have given the format here for the fixed interest bearing securities and variable interest bearing securities. Separately I have given. Right. Anyway, solve and then later I will explain the format. Okay. Because solution is very simple. We'll start with the first illustration. Bolu sold 2,500, 9% debenture face value being 100 of Madhu Limited at 135 X interest on 1/4/2024. Interest payable on 30th June and 30th rate of interest applicable to the period of holding. I just calculate for per unit basis, per share, 100 rupees is the face value. Sold at 135, what interest means without adding the interest component. The date of sale being accrued but is not eligible for getting it. As per the contract, the company will pay the dividend as an interest only on 31st December or 30th June. It's the halfway through you cannot get, but as in the date some amount of interest could have been accrued. So that will be calculated as per this one. Face value of the share debenture being 100 into rate of interest being 9% and the period accumulated, the interest accumulated for 3 months. Okay, then the value being how much? $2.25. So how much you have to pay? 137.25 you have to pay. So for the debenture, how much you have to pay? The debenture, bond, whatever it may be, should appear at its own X price, X interest. The interest would be separately handled. The entry being bank account debit to debenture, amount being 137.25 for the seller. For the buyer, it's reverse. And for the 3 months, 2.25 is there. No, I receive this bank account debit and interest accrued for the period is my income transferable to the P&L account being 2. This is 135, sorry. X interest price 135 and this is 135. The 2.25 in addition to that value I get is my income transferable to the P&L account. Transferable to the P&L account. Is that clear? So here I have given the format. In case of purchase or sale, you better follow these 3-line step. X interest price is the actual cost of purchase. This is the value at which it is going to be recorded. With that, you have to add the interest. How can you calculate the interest? The face value of the debenture purchased or sold and applicable rate of interest, eligible period for the interest. Prior interest payment date to the date of sale may be called as accrued interest on that. And cum interest, that is the amount you pay. Usually, this is our value of the asset. This will be the interest considered as income and expenses. For the recipient, it is income. For the payer, it is expenses. Hope you will be now able to understand this one. Clear? Step number 2. So I followed only the step number 2 for calculating this question number. Keeping the format as it is. We have 2 types of securities. Fixed interest bearing securities and variable interest bearing securities. In case of fixed interest bearing securities, how can we solve this? Now tell me. Now tell me. Fixed interest bearing securities like debentures, bonds, etc. Debentures, bonds, etc. You better have 3 columns. Number of debentures you have, one column is for interest, another column is for value. As you are being the investor, it's an asset. Okay. Investor's point of view. Debit and credit. Now come on, tell me. This is what about the value of your, should be the asset account. How should be the asset account? Okay. How should be the asset account? Normally, asset account will appear like what? Opening balance, debit side. Closing balance, credit side. Any transaction increases the value of the asset, post in the debit side. Decreasing the value will be post in the other side. Clear? Now, when it is increasing, if you are purchasing, that it will be increasing. When you sell, this will be decreasing. Right. Apart from that, on purchase or sale, you may face either profit or loss. In case of profit, actually it is increasing, shown in the debit side, profit on sale. And loss on sale will be the other side. Loss on sale will be the other side. Clear? Now, opening how much you have, any purchases and any sale. What about the closing value you have? And do you get either profit or loss because of holding the bond? Okay, if the profit being shown in the debit side, loss being shown here. Very simple. This will be based on the number of debentures. 10 debenture per debenture, 100 means 1000. Now tell me, at what value you show here? Cost or NRV, whichever is lower in case of current asset, current investment. In case of non-current investment, always shown at the cost. Clear? Now what about this? See, this may be simply numbers. This may be simply numbers. 100 debentures, 1 lakh rupees. There is no any confusion. There is no any confusion. Now what about the interest component, sir? What about the interest component? See, Interest is payable on 30th June and 31st December every year. Assume that the debenture carrying 12% interest per annum, face value being 100. You have 10 debenture cost. Cost is always what? X interest price. Cost is always X interest price being 95. This is the value purchased. And this is available as opening balance. Opening balance. How can you record? You can record this way. You can record this way. How? You have one debenture valued at rupees 95. Either you can number this or you can write the nominal value. 100 rupees is the nominal value, but cost being 95. Don't forget to calculate and fill this column also. Okay. Interest account debit to bank, like this amount is what? Anything appearing the debit side, the top is asset. Means any income recoverable remains not recovered is your asset, should be shown here. Outstanding interest. This is accrued interest or outstanding interest. How will you calculate the outstanding interest? This one debenture you have, 10 rupees, 100 rupees. The year beginning being 1st April 2026 every year, assume April. But this company has issued the interest on these two dates. As on the year end, year beginning, prior to that we might have received the interest only on 31st December. From 31st December to this 3 months interest could have been accrued. So 3 by 100 into, 3 by 12 into rate of interest applicable for this being 12%. What's the value? 3 rupees. Hope now you'll be able to understand. This is the accrued interest. When the due date comes, you receive this. So bank account, you receive the interest. You receive the interest. 1 year later, you get around 15 rupees. 3 rupees earlier recoverable. 15 rupees is the interest received. In the year end, we still have 2 more outstanding interest. So 15 plus 2 minus 3, 14 is nothing but amount of interest applicable for the period transferable to the P&L account credit side. Transfer to P&L account credit side. Transfer to. What is the net interest for the period? Opening outstanding means interest received maybe 15 plus outstanding of the current year, which is 2, minus outstanding of the previous year 3. So 14 will be the amount transferable to the P&L account. No, that is stated as an account here. Opening amount. Any amount received, add 3. And what about the amount recoverable in the year end? Opening amount recovered and amount recoverable in the year end 17. Amount already remains outstanding in the previous year subtracted. Interest for the period 14 is transferable to the P&L account. That's how it's your duty to find out the opening outstanding as well as closing outstanding both. See the format, very clear one. Very clear one. In case of fixed interest bearing securities, opening balance and closing balance, either it may be number or nominal value, you can write in both the way. Value being, what is that value? Cost or fair market, whichever is lower. What about this interest? Interest accrued as on the date, outstanding interest, calculated here. Fair value of the share, debenture, into rate of interest, number of period accrued for. This will be this value. Such a way you have to calculate the opening value as well as closing value. The method of calculation of these two is given in working note number 1. Clear? Clear? Next, in case if you purchase anything, any new investment, you have to calculate what? X interest and interest accrued on that separately. How do you calculate? X interest accrued on that, and the amount you pay for this being cum interest. The interest for the securities being nothing but fair value. into applicable rate of interest and number of months eligible for that. If you calculate all these things, this is the amount you're supposed to pay. Though you pay this much, for the securities value, you have to show X interest value. So this will be the new purchases. This is what about the second working note. This is what about the X interest price. This is X interest price. And this is nothing but the interest you are paying and purchasing. So this is the number of shares. That hope will be now able to understand the second format for purchasing anything. Also given in second working note. Okay. X interest, interest from interest. X interest is the cost of purchase, will be shown in the cost column. Interest will be interest up to the date, will be shown in the interest column. The more overall amount you pay here being amount payable. Is that clear? Now, so for the interest, any amount received as interest for the period is this one. And year end this value. You tally that interest column and the whatever the balance you get, it is nothing but amount transferable to the P&L account. Amount transferable to the P&L account. Hope. In case of interest, amount transferable to the P&L account to be calculated. It will have opening outstanding, closing outstanding, and amount received, and net will be the amount transferable to the P&L account. You usually prepare a working note simply while preparing the single entry as well as non-profit organization. Here I am converting that into an account. Now, how can I calculate the profit or loss on sale of the share? In case of debenture, I purchased for 100, sold for 105. Then purchase price, sale price, the difference between these two 5 will be called as profit. 5 will be called as profit. Is that clear? Provided, what about this hundreds are? Whenever we are talking about any debenture, the price will be always what price? X interest price will be taken. So for calculation of any profit or loss, is that okay? Because of sale of investment, this component, okay, can be calculated by comparing the sale price and purchase price at the X interest rate. Working note number 3. Profit or loss on sale, X interest sale price minus X interest purchase price will be your profit or loss transferable to the P&L account. Either you can calculate under FIFO method or weighted average pricing method. Okay, weighted average pricing method. The ultimate amount transferable to the P&L account is what? Related to the interest as well as related to the profit or loss on sale of the asset or carrying value of the assets. That's what about the fourth block, the amount transferable to the P&L account. Hope you will be now able to understand all the cases. Let me solve one illustration here to make you understand much better way. Okay. Question number 2. Shall I solve this? Only 4 points. Those 4 points are more than enough to make you understand the logic. Yes, come on, join with me to solve this illustration. Now, Jaipur Investment Limited hold 1015% debentures. What is your investment? 15% debenture is your investment. First column is for numbers, another column is for interest, another column is for cost of the asset investment. Or you can open two accounts simultaneously, interest account separate and cost account separate also, right? No problem here. So, number, interest and cost. Now, 1000 share already held on which date? 1st April. 1st April, balance brought down. How many debenture held? 1000. At a cost of rupees 1,05,000. What is the cost? 1,05,000. Interest is payable on 30th June and 30th September. Interest due date being 30th June and 31st December. Interest due date. Now, as on 1/4, no. 1/4 means what could be the interest component here? I work out here separately. 1000 shares, debentures, face value being 100, interest will be payable on face value. And the rate of interest applicable being 15%. For this, when did we pay the interest lost? The interest paid on this being, we are in 1st April. Earlier to that, 31st December might have been paid. So, January, February, March, 3 months interest could have been accrued. What's the value? 3,750. This becomes outstanding. Opening accrued. 3,750 being the opening accrued. So we got this value. Hope you will be now able to understand the determination of the opening value. And on 1st May 2024, find the debentures are purchased cum interest. On which date? 1st May. Bank account. While purchasing, what do you do? X interest, add cum interest, then, add interest, the ultimate value being the payment. Cum interest. X interest, interest and cum interest. Right. Find debentures are purchased cum interest 53,500. Cum interest means put that value here 53,500. How do we calculate the interest? Face value into rate of interest and number of periods applicable for that. Find debenture means the face value being 100 per debenture, 500 into 100, 50,000. Applicable rate of interest being 15%. Into how many months? 1st May. Earlier to that, when did we get the interest? Only 31st December. January, February, March, April, May 1st. So April, 4 months interest could have been accumulated on that. So 4 by 12. 2,500. As this value being 2,500, the X interest price being 51,000. So the number 500, interest component 2,500, amount applicable for the investment being 51,000. Is that clear? On 1st November 2024, 600 debentures are sold X interest. Sale happens on which date? 1st November, bank. X interest, how many debentures? 600 numbers. X interest being 57,300. I need to calculate interest only. Okay, I'll put that value here. Okay, which date? 1/11. Why do I put it separately? Because beforehand we reached 30th June, no, we might have received the interest. So you can pass the entry for the receipt of interest. So 30th June you get the interest, bank. How much interest you will get currently? As on this date you have 1,500 debentures. So as on the date you already have 1,000 purchased under 500 and 1,500 into 100 on that interest rate being 15%. For how many months you have to calculate? 6 months, 6 by 12, half year. The value being 11,250. After that, we'll go for which date? 1st November. Bank, you sell the securities. Clear? Yeah, tell me. 600 debentures are sold at the X interest. 57,300. 57,300. Now, while selling, what will you do? How much you will collect? This will be repeated. X interest, add interest, you collect cum interest. The amount for the debenture being 57,300, X interest being 600 debenture means 60,000 face value into rate of interest 15%, the date being 111. Before that, we got the interest on 36, 7, 8, 9, 10. 4 months are there, so now you have to calculate 4 months interest. 4 months interest. 3,000. How much you will now collect? You will collect 60,300. 3,000 rupees is for the interest, 57,300 for the security. Now number of debentures sold being 600. Now tell me whether do you get profit or loss because of this? Profit or loss because of this? How do you calculate the profit or loss? X interest, sale price minus X interest purchase price. Okay. X interest sale price being 57,300. X interest purchase price under what method? I adapt FIFO method. Assume FIFO method is used. Then between these two, from this you might have sold 1,000. 1,000 debentures purchased at 1,05,000 means 105 is the X interest purchase price per debenture. For the number of debentures sold in this case being 600, so 600 into 105, how much is that value? 63,000. Now the difference between these two, purchased at 63 but you sold at 57,300, then you face a loss of 5,700. Loss on sale. Loss on sale will be posted here. Loss on sale. Working note number 4. You lost 5,700 for sale of investment. For sale of investment under FIFO method. Again, 30th November, 400 debentures are purchased. 30th November, bank. 400 debentures purchased at 38,400 X interest. X interest can be posted here. If it is being cum interest, it's a duty to find out X interest and post that X interest only in the last column. And what about the accumulated interest on this? Number 5. So, 400 into 100, 40,000, interest rate 15%. For this newly purchased debenture, interest released beforehand on 36, 7, 8, 9, 10, 11, 5 months interest is going to be accrued. 5 months. Then what is the value? 2,500 will be the accrued interest. So, 2,500. 2,500. On 31st December 2024, 400 debentures are sold cum interest. Again on 31st December. Interest date is also same, but on the date itself sold as cum interest. Cum interest means inclusive of interest. 6th adjustment. Bank 6th adjustment. How do I calculate? The same way. X interest. Add accumulated interest on that. Cum interest is the amount recoverable. 400 debentures, no, 400 debentures. Cum interest price 55,000. What about the interest component here? 400 into 100, 40,000. 40,000. Accumulated interest being 15%. Entire 6 months is over. Even if you hold one more day, you will get the money, but exactly the last date before you release, you sold. So 6 by 12. What is the interest? 3,000. Then actually the worth for debenture being 52,000 only. So 400, you got interest and 52,000 rupees is for debenture. Find out whether there is any profit or loss on that. X interest sale minus X interest purchase. And what method we are going to follow? FIFO method. FIFO method. X interest sale being 52,000. X interest purchase, FIFO method, out of 1,000 already we sold 600, another 400 also be saleable from here only. 1,000 valued at 1,05,000 means for one share, one debenture is for 105. So 400 into 105, what is the value? 42,000. Then how much will be your profit? 10,000 is your profit on sale. So profit on sale should be posted the other side. 3112. Profit on sale. Profit on sale. 10,000. So everything is over. Now I have to close the books. Close the books. Yeah. So I am going to close the books. Okay. Now, we have 1900 debentures, 1900, 1000 sold, 900, still we have the balance. This is called balance. And which date? But meanwhile, interest is also recovered. No, so bank, I missed that. So bank, on the same date, we receive the interest for the remaining debentures. How many debentures we have? 900 debenture. 1,900, 1,000 sold, 900 debenture at rupees 100, 90,000 into 15% for half year. What is the interest? 6 months. 6,750. Isn't it? 6,750. Now year end we have 900. What about the value here we have? We have to show what cost. What is the cost for the remaining unsold assets investment? This 1,000 was already sold. Under FIFO method, this 1,000 sold. These two remains unsold and cost of that being these two. Cost of these two. 89,400. 89,400. 89,400. Clear? And don't forget to calculate this interest. How will I calculate? For the 900 shares at the rate of rupees 100, 15% interest could have been accrued from the last interest payment date to this date. Last interest payment date being 31st December. Now we are on 31st March of the next year. March of the next year. 3 months already over, so you have to calculate interest for the 3 months. The value being 3,375. 3,375. Okay. Come on, finish up tallying that interest column. 27,375. 27,375. This is opening outstanding. This is closing outstanding. This is the amount you received. This is the amount you received. Okay, balance amount, if any, is nothing but transferable to the P&L account. 31st January, March next year. Transfer to P&L account. How much is that? 18,625. 18,625. And cost column gets tallied, I think, 2,04,400. 2,04,400. So here, investment being the asset, treat like asset. Interest being the income, treat like income account. So one income account, one investment asset account. You prepare that in columnar form under investment chapter AS number 13. Clear? In case of fixed interest bearing securities. Now let's move on to the next illustration. Question number 3. Question number 3 is all about Bonanza Limited held 9% government loan. Okay. First in, first out method shall be followed. So what method we follow? And the balance of the loan held by the company shall be valued at to average cost or market price, whichever is lower. Finally, closing investment, no. In that case, average cost or market price, whichever is lower method will be calculated. During the sale, you have to follow FIFO method. Finally, on closure, the closing value, what you get, that is the average value is compared with the market value, whichever is lower will be taken. Come on, prepare the ledger. Yes. I will start with 4 lines to be posted. Yeah, join with me. Yeah. First April 24, 2 lakhs, 9% government loan at 1 lakh 90. 9% J loan. 9% J loan. Nominal value, interest and ex-interest price of the investment. On 1st April, balance brought down being, I can assume the face value of the loan being 100 means 2000 being the number of debentures government loan we have, and the price I paid being 190. 3 months interest had accrued on the above date. On the date, 3 month interest is accrued. Number 1. For this face value, applicable rate of interest being 9%, as on the date 3 months interest is accrued. Then this value being 4,500. 4,500. First one is over. Right. On 31st May 24, the company purchased the same government loan, face value 80 at 95 net. 95 net. Cum interest price. On which date? 31st May. 31st May. As you are purchasing, it increases the value. Working note number 2. How do you calculate? X interest, and you get the cum interest. Interest being 80 means 800 debentures or bonds you purchased. Okay. 95 cum interest means 95 into 800 you could have paid inclusive interest. 58, 650. Interest component being for the face value at the rate of 9%. As you are aware about the 3 months is already over, 4 months. As on 1st April, 3 months over, up to May, 5 months is there, so you have to calculate 5 months interest. Okay. This value being 76,000. Okay. And this value being 3,000. Your X interest price being 73,000. X interest price being 73,000. So 73 X interest price, interest being 3,000. On 1st June 2024, 60,000 face value of the loan. What happens? Let's see in this case. What happens here? 60,000 face value of loan was sold for 94x interest. 94x interest. I'll pick another 4 lines. Yes, come on, tell me. On 1st June, what about the interest due date? I need to know that first of all. Face value, okay. Interest on loan was paid each year on 30th June and 31st December. Okay, what are the dates? 30th June and 31st December. Now here it comes on which date? 1st June. Okay, so only after this we have to go for. So we'll finish up this calculation. 60,000 face value of the loan was sold here on which date? 1st June. Bank. Face value being 60. Calculate everything separately here. X interest, cum interest. Okay, 94 net. 60 face value means 600. Okay, I can make it 600. 94 X interest means 600 bonds sold at rupees sold at rupees 94. 56,400. Interest component will be calculated based on the face value. 60,000 into 9%. For how many months? Earlier to that, 31st December was the payment date. From there, here 5 months is there, so you have to calculate for 5 months. 2,250. Okay, 56,400 is the amount paid for sale. Interest as on the date being 2,250 collected. How can you calculate the profit as on the date? X interest sale price minus X interest purchase price. The X interest sales price being 56,400. As we follow FIFO method, what method? FIFO method. 600, we assume that 600 is only out of the opening balance as we follow FIFO method. 1,90,000 we paid for 2,000, but out of that 600 only sold. For the 600, what could be the value? 600 divided by 1,900. That's what about the X interest purchase price for the 600 units. Final value being 600. You lose 600. Am I right? Loss. Yes or no? 56,400 minus cost of acquisition under FIFO method. For that 1,90,000 is for 2,000 shares purchased. Out of that 600 share, purchased could be 57. Purchased at 57, sold at 56,400. Actually, I am losing 600 rupees. Loss will be charged to the P&L account and it will decrease the value of the asset. So I put the value here. Loss on sale. Loss on sale. 600 rupees. And now interest date comes 36. Bank. You will get the interest. Working note number 4. As per the fourth working note, face value into rate of interest into an applicable period. 2000 plus 800, 2800, out of that 600 sold, so 2200 worth bonds we have, face value being 100. On that 9% for 6 months you have to calculate. This value being 9,900. So we receive that interest 9,900 for interest component. On 30th November 2024, 40,000 face value of the loan was sold at 97 net. Again there is a sale on 30th November. Bank. Okay. Bank. Now, fifth one. Bank. X interest, add interest, you will get cum interest. Face value 40,000 means it may be 400 bonds. At 97 cum interest. So 97 into 400 will be the cum interest value. 38,800. Interest component being the face value being 40. Applicable interest rate being 9%. Period applicable for interest. Earlier payment being 36. From there 11, 5 months is there. So into 5 by 12. 1,500. Then excluding interest it should be 37,300. Fifth adjustment. Interest component 1,500 and X interest component being 37,300. On 1st December 24, the company purchased the same loan 10,000 par X interest. On which date? 1st December. Okay, bank. 10,000 means 100. Okay, 6 to 1. X interest, cum interest. The amount 10,000 purchased at 10,000 X interest price. Then we have to pay the interest component also. 10,000, rate of interest 9% for how many months? As this is being the 1st December, 5 months over. Surprising in this illustration, all the interest calculations for 5 months. Interesting illustration. Though you calculate, again end up with only 5 months. Yeah, this value being 375? 375. Then 375 is the interest. Again we go for the 1st March. 1st March means in between we get what? Interest payment date. So on interest payment date you will get the interest 3112 bank. How much interest will you get? As on the date, how many rupees worth the debenture you have at face value, on that interest is calculated. Clear? Seventh one. 2,900, 1,000 sold. Okay. 2,800, 100. As on the date, sale being 600, 400. 1,900 you have. Per debenture face value being 100. Rate of interest 9%. Period periodical payment is applicable for half year. What's the value you are getting? 8,550. $8,550. But I missed to calculate the profit and loss on this sale, this 400 sale, isn't it? Did we calculate? Working note number 5. Oh, we missed to calculate the profit here. Now, I'll extend that one also. X interest sale minus X interest purchase. X interest sale being 37,300 minus, out of the first in first out method means from the opening balance only I am selling. 1,90,000 rupees is for 2,000. Now the sale is only 400. So for 400, how many? What could be the value? This value will be subtracted from 37,300. I hope you will be getting 700 loss. 700 loss. This one 600 profit, I think so. Make a correction. Check, cross check.
Yeah.
Okay, loss. And what about this one, 700? What about this one? This is also loss. Loss should be posted here. Linked with this one. Loss on sale. But in text it's wrong, right? Okay, correct that in text. This book was updated in the last batch, so I missed it to correct it properly. Okay. So after that, what I'm going to do? Up to this over. On 1st March 25, the company sold 10,000 face value of the loan at 95x interest. On 1st March. Again, one more sale is there. 8th one. X interest. I'll post that value here. 8th. X interest, interest, cum interest. X interest, interest and cum interest. 10,000 worth, right, sale on 1st, which date sale happens? 1st March. Bank. 100 worth. Sold for how much? 95x interest. So 100 into 95x interest. You'll get 9,500. What about the applicable interest? Face value into rate of interest 9%. Applicable period being 5 months again. This question setter is fond of 5 number. Always 5. And what is the number here? 375. 375. This is 3. Is it purchase or sale? Sold only. Sold only. That 1st March. Oh, 2 months. 2 months. Okay. January, February. 2 months. Okay. The interest paid, the last being December. From there it is only 2 months. Okay, thank you. Then what about the value? Yeah, okay. I doubted whether he is fond of 5. No. Okay. So 150 for interest and 9,500 for X interest. Clear? X interest. Then, shall I move to the next one? The market price of the profit and loss to be there. Okay, sorry. X interest, sale minus X interest, purchase price. Sale value being 9,500. Purchase price being, from this original balance you are going to purchase, opening balance, 1,90,000 for 2,000, for this 100, how much it should be? Huh? No profit, no loss. Okay, good. Then what more? The market price of the loan on the year end being 96, market price. So, market price being 96. Market price plus and average price, whichever is lower will be the closing value. We will get it later. Now, before that, on 31st March, what do you have to do? Again, calculate the interest component. How much is the interest here? 9th working. This is 8th, this is 9th. 9th. 2,900, out of that 1,100 sold. Okay, 1,100 sold. Then 1,800 is the balancing number we have into 100. Interest at the rate of 9% for 3 months to be calculated. Oh, it's not payment date, sorry. It's not payment date but closing date. Okay. Then it is balancing figure. In that balance you can get this value. Sorry. Okay. Balance. Come on, tell me. The value being 40, 50. 1,800 debentures or bond we have. Accrued interest on that being 40, 50. Accrued interest on that being 40, 50. How can we calculate the value? Okay, under weighted average and whatever it may be, simple average. And 1,800 market value being 96. If I multiply these two, what is the value you are getting? What's the value? 1 lakh? 1,72,800. Then average profit price 73,000 and 10,000 plus this one remains unsold, this one remains unsold. In that 2,000, 1,100 sold, then 900 still we have 1,90,000 rupees divided by 2,000. Out of that 900 remains pending. 900 remains pending. Take this value. Come on, get me this value. I think this value being 1,68,500, between these two, whichever is lower, 1,68,500 will be taken. Clear? Cost or NRV, market price, whichever is lower is taken. Now come on. We try to finish up the first one. In case of numbers, it will be automatically tallying 2,900, 2,900. Interest component 26,400, 26,400. Balance transferable to the P&L account 18,525. I think as the cost price is appearing rather than adjusting to the market price, automatically the last column will be tallying. Sir, you told me average price, but you have taken actual price. It's nothing but average price. If you add all the value and divide that by the average number of shares, then you will get the average price. If you multiply with the same number, you will get the same number. Okay, that's why I have taken directly. The next interest, if I tally, this will get closed at 2,73,600. 2,73,600. Clear? Come on, make note of it. This is 10,000. Okay. In case of variable interest bearing securities, in case of variable interest bearing securities, so we don't have what column? You no need to worry about the interest column. Okay. We'll first try to finish up the illustration. Now come on, tell me. Show the investment account in the books of Krishnamurti. So investment account, investment. On 1/4/24, Mr. Krishnamurti purchased 1000 equity shares of ₹100 each in Tata Steel at 120 from broker who charged 2% brokerage. Then 2% means 2.4 will be addable on purchase price. 122.4 will be the value. He incurred another 50 paise per 100 as cost of shares transfer stamps. You have to add another 0.5. Otherwise 2.5%. You can make it 2.5%. 2% plus another 50 paise. So then the value being 3 rupees, 123 is the purchase price. Clear? So 1/4/24, it's all about equity share capital. Fixed variable interest bearing securities. Bank. 100,000 equity shares are purchased. Per equity share purchase cost being 123 means 1,23,000 in total. Two. As you hold this share on 31/1/25, you get the bonus share. While getting the bonus share, you don't pay any money. You get the number of shares increased. 1 for every 2 means for 1000 you get 500 bonus share. Number of shares increasing without increasing the value. Before and after the record date of bonus share, the shares were quoted at 175 and 90 shares per share respectively. That doesn't matter. On 30/3/2025, Mr. Krishnamurti sold bonus shares to a broker who charged 2% brokerage. So now on sale, this value being 90, 2% brokerage is payable, 1.8. Then 88.2 will be the value, 88.2. This is the amount you recover on 31/3/25. So 31/3/25. Bank, you will get how many shares are going to be sold? Only the bonus shares 500 into 88.2. What is the value you are getting? 4,400. We cannot find out the profit or loss as on the date. Then how can we identify, sir? As on the year end, 31st March 25, you still have how many equity shares balance? How many? 1,500, 1,500, 1,000 you have, 1,000 you have. Now, you can find out the value by this way, cost or NRV, whichever is lower. whichever is lower. What about the cost? What about the cost? 1,23,000 you paid for 1,500 shares. Out of that, 1,000 shares remains unsold. Then what about the value? NRV being, currently it is saleable at 88.2 into 1,000, 88,200. Between these two, whichever is lower, 82,000. Now tally the cost column to find out if there is any profit or loss. 1,26,100, 1,26,100. The balance what you get here is being your profit, 3,100 profit and loss. Transferable to the profit and loss. Is that clear? Now let's move on to the next one. Here there is one more variation. Also calculate assuming that all shares were sold. Already defined what happens in case of sale of partial share and complete share, right? Somewhere in the earlier page. So we have completed the partial share sale. Now I am going to consider this being the complete number of shares sold. In case of complete number of shares sold, very simple, 1,500 is assumed to be sold. At what value? The same 88.2. You will get 1,32,300. As you don't have the balance, you simply tally and find out any amount transferable to the P&L account. 1,32,300. The amount transferable to the P&L account being 9,300. That's all. Clear? In case only partial shares transfer, for the balance you have to find out the cost or with NRV whichever is lower. If all the shares are sold, close that directly. Any balance is there, no, that will be profit or loss. Now let's move on to the next comprehensive illustration where we have the bonus shares, right shares and all we calculate in detail related to the variable. Let's go to the next illustration, question number 5. One of the comprehensive illustration. Also, this one is available in your material, study material also. Right. Let me start with the first paragraph. So what are the requirement? Prepare investment account and profit and loss account also. Assume the books are closed on 31st December and shares are valued at average cost. Year end being 31st December. Investment account. 1st Jan 2024, I can make it 1st Jan 24. 1st Jan 24. Balance. 25,000 equity shares. Numbers. 25,000 equity shares. What about the value? At the book value of rupees 15 per share. Face value not matter. Book value being 15. So 3,75,000 is the purchase price. Opening balance. On 26/24, he purchased another 5,000 shares of the company at 16 per share. So 26-24 he purchased further shares, 5,000 shares. The purchase price being 16 means 80,000 rupees paid. The directors of XD Limited announced the bonus and right issue. No dividend was payable on this issue, and the terms of the issue are as follows. Dividend is payable only for this, and we still have the bonus share and right share. For these two share, okay, dividend will not be available. Dividend will not be available. Now let me try to incorporate this part. Okay. Now we'll start with the bonus share. One share for every 6 share on 16/8. Right share is only after the date. First announce the bonus share. In case of right share, the question is whether he executes or renounces. That question is there. So for the bonus share, definitely he will be enjoying. On which date? 16/8. Okay, 1/6. For every 6 share, 1 share, currently he has 25 plus 5, 30,000 share. 1/6 means 5,000 shares he gets, but value being 0 at free of cost. And right share is also there on this date, 31st August 24. 3 for every 7 share. 3 for every 7 shares. And then the payment date being 39. Payment date being 39. Currently how many shares we have? 25 plus 5 plus 5. Okay, right issue. 25, 5, 5. 3 shares for every 7. So 15,000 shares. Now the question is whether he purchased all or not. We'll see the info. But in case of bonus share, no problem. In case of right issue, we have to go further. Here is. Shareholders can transfer their right in full or in part. Accordingly, Sundar sold 33% of his entitlement to Shekhar. So 1/3 is transferred. 5,000 transferred. At a consideration of rupees 2. Balance 10,000, we assume he has excised this. Okay. Clear? How to post? Right share, 10,000 shares purchased. What value at which the right share is purchased? 15 rupees. 1,50,000. On the same date, renouncing the right happens 39/24 bank for renouncing the right. Right share renouncing. Number and rupees. Okay, number and rupees. You get 10,000 rupees. Don't write the number here because it's not actually share, it's only right. The number represents number of shares. This 5,000 is number of rights you have, it's not share. This one, the right is converted into share, then it is coming in the column. Right, means share column. Clear? Now, what more? Dividends for the year 31st March 24 at the rate of 20% were declared by X Limited. 31st March. Make it 31st December 23. Because correction is needed, right? Correction is needed. Make the correction. So now see the amount paid here. The amount paid here 3,75,000 and this 80,000 includes what? dividend component also. This payment is cum dividend. Whenever you are receiving the dividend, automatically this will be subtracted from the asset, means a share. So cum dividend is released. Otherwise, pre-acquisition dividend. Pre-acquisition. Post-acquisition means can be transferred to the P&L account. It's a pre-acquisition dividend. So the dividend is related to the previous year. Only after that we purchased. We purchased and we are getting the dividend out of the income earned in the previous year. Pre-acquisition dividend. For how many shares? 30,000 shares. Face value being 10 and dividend rate being 20%, means 2 rupees per share. And received by Sundar on 31/10/2024. Dividends for the shares acquired by him on 26/24 are to be adjusted against the cost of purchase. And for this, okay, now this date is correct. I just stand corrected. As it's the first time I made the material, I'm not sure whether there's a correction required or not. So this 31/3/24 is correct. The correct only. So from this, it's very clear we have currently getting the dividend for 2 shares. 2 shares. For 25,000, for another 5,000. For this, of course, dividend not eligible. For this 2 rupees, here 50,000 rupees, here 10,000 rupees. Clearly stated. But dividend for the shares acquired by him on 26/24, this one, are to be adjusted against cost of purchases, means this one is called pre, this one is called post. This will be transferable to the P&L account. This will be subtracted from the cost of acquisition. So I put that value here, bank, the value being 10,000 on this date, on the receipt date being 31/10/24, 10,000 rupees. This value will be adjusted in the cost of acquisition. This will be transferable to the P&L account. That's why they have asked to prepare P&L account also. 15/11, Sundar sold 25,000 equity shares. 15/11/24. Bank, 25,000 shares sold at a premium of ₹5 per share, means 15 rupees. 3,75,000 received. 3,75,000 received. Okay, I have completed. Now finish up tally. In case of units, 45,000, the value being 6 lakhs, we will write the value later on, 45,000. Closing shares we have here being 20. As on the year end, 31st December 24, balancing figure. Balancing figure. Is that okay? Now what is the value? How can we determine the value for the closing balance? Shares are valued at average cost. What is the average cost? The cost being, come on, get the total of these things. 3,75,000, 80,000 rupees, 1,50,000, 6,05,000. The amount adjustable in this 10,000, another 10,000, another 10,000. What about the then balance value? 5 lakhs? 5,85,000 will be the value for 45,000 shares. Now how many shares we still have? 20,000. What is the cost of the shares we purchased? This much. From that what you have to subtract? Pre-acquisition dividend should be subtracted. One is pre-acquisition dividend, another one is X interest, X means cum right to rise. The right renouncing value, that should also be subtracted. After subtracting, we came to know the real cost for the 45,000 is 5,85,000. Out of that, 20,000 remains unsold. The value for this being 2,60,000. You post that value here, 2,60,000. Now tally that investment and find out whether there is any profit or loss. I think This side is 6 lakhs 5,000, this side is 6 lakhs 55,000. Definitely you get a profit of rupees 50,000. 6 lakhs 55,000. This is balance carried on. And also you can prepare the P&L account. In your P&L account, what you have to do? This profit is transferred to P&L account, sorry. Profit on sale, how much? 50,000. Apart from that, the dividend transferable to the P&L account, post-acquisition dividend received out of post-acquisition. Pre-acquisition subtracted here, post-acquisition is transferred to the P&L account. That's all. So in case of variable nature, the sum seems to be pretty simple because interest column is missing. In case of fixed, then interest column is also be there. Okay, you have to understand this one.